Really?
Like we're seeing, yeah. Here, I'll put this up.
Are you saying overall or cloud in general?
Overall, I can take a look at cloud here in a sec. But this is overall growth rates. I have the revenue broken out into each category anyways. But the last time that we've grown at over 17% was back in March of 2022 at 23%.
Wow.
Okay. But cloud specifically, let's take all this off really quick. Google Cloud and growth rates. Yeah, dude, like I got to zoom out to look how fast they've grown like this. Last time that they grew this fast was June of 2021. This is accelerating.
And look at how much revenue they
generate. That was from such a small base.
What?
I said, and that was from such a small base that when they saw that high growth, and now you see that nice harder comp right now, and they're still growing at crazy levels.
Yeah, and you don't want them to spend on capital expenditures. Like, what does the market want them to do?
Make it make sense, Tanner.
The little green we saw is back to being red. I mean, this is a broader issue with the entire market. It's like, do you love me? Do you not love me? Do you love me? Do you not love me? Like, do you hate SaaS? Do you not hate SaaS? Google, do you want them to spend CapEx or you don't? I mean, imagine they said we're not going to be spending as much CapEx as we thought, and then the cloud revenue growth was still, subpar. It's like they have to spend to be able to put up these numbers. So a lot of this just feels like indiscriminate selling here, or maybe for a different reason. But I think that's why the stock is flat. It's not up or down. Street can't make up their mind right here. Alpha is up 16%. Again, they had a pretty good beat, which was very good. Micron, is that pumping because of this? Micron is up 3% after having a 9% down day. Broadcom up 6%. I almost bought this one today at 305. I didn't pull the trigger, but I almost did. Google, very bullish for Broadcom, as they are a big partner with TPUs. Actually, Amcor should get some benefit from this. Amcor's down after hours. Weird. Amcor usually pumps with Broadcom. Google right here, flat after hours. Qualcomm still down 7%, and then ARM down 7% as well.
Also, the margin on Google Cloud here, climbing to the highest rates that they have, it grew by 153%. So they're not just making revenue on this, they're making nice operating income. So do I have a margin here for them? Google Cloud operating margin now at 30%. Look at that. That's a magical chart right there. All right.
No, it's incredible. AMD as well is up about 1.4% after hours as well, based on.
And yeah, Nvidia's trading at lower than a 25 forward PE ratio at these levels. I just don't know.
They expected $120 billion in CapEx, less than that, 119.5, and now what they're going to see is 180 billion. Who do you think they're spending that with? Come on, Broadcom. Nvidia
getting a little green after hours. Sam, your thoughts on this print?
So, I mean, I thought Google Cloud was ridiculous. That was 48%, right? Is that the number that I'm saying?
Yeah.
Correct.
That's the print that I'm looking for, because that really helps with the Amazon thesis, helps with the cloud thesis. $180 billion of CapEx. Well, that's no joke. And then what, they spent like $80 billion in CapEx last quarter? I don't know how you spend that much money, but it's making Meta look, it's making Mark Zuckerberg look like small fry at this point. I mean, what were the expectations coming to earnings? They're pretty high. I'm surprised it's not down on this news because of that CapEx, but clearly it's not a problem. I think what we want to know is, where's that backlog come from Google Cloud? If they say that's come from OpenAI, which I doubt it, that'll be fine. But if they say it's come from Anthropic, I think the stock is going back up. Now it's down 2%.
That's a good point. If they say a lot of this is due to Anthropic spending with them, maybe the street likes it. If they say it's OpenAI, Google down 2% right here. Jose, you have any thoughts on that? If they mention OpenAI here?
I mean, I think they have that partnership with OpenAI. They have partnership with Anthropic, but I would guess most of their RPO would have to still be from internal Gemini solutions. So I think that's what they're doing. And if they're releasing more Gemini to the consumers, right? If they're starting to release more consumer products, you're going to see more cloud. So I'm going to guess is they can easily easily say it's purely just mainly Gemini, and then anything else is an additive to it. So it's OpenAI is additive, Anthropic is an additive, but I think they can push more the Gemini route is the one that's pushing some cloud demand there.
Dude, free cash flow didn't even go down.
That's wild, right?
They put up $24.5 billion in free cash flow, which was more than last quarter, while spending nearly $5 billion more in CapEx.
And that's I think that's the greatest argument to AI ROI. I mean, it's like you're spending this much money on ROI, but yet you're still spent on AI CapEx, but yet you're still seeing that free cash flow continue to be extremely healthy. That everybody, I mean, Jensen has said it. Once your GPUs turn on, it's a revenue driver, it's a money maker for you. And I think these numbers, Meta did the same thing, right? Meta had crazy CapEx and they still had crazy free cash flow. That's an easy indication that, look, this AI investment is providing the ROI that we need to buy more and more.
I'm going to
even
sleep like a baby
for
tonight.
the trailing 12 months, free cash flow is flat despite the huge increase in CapEx. Like for the trailing 12 months, it's flat, yet CapEx has exploded. This is magnifique.
There's your CapEx right there. Again, they continue to spend at a pretty aggressive level, but they are putting up the growth to get there. Here is the ARM numbers as well.
Case of where the guide just isn't enough. We're seeing an EPS and a revenue beat for the third quarter. So earnings per share 43 cents on revenues of $1.24 billion. Ben just talked about, if they guide up, investors will forgive. Well, it seems like that's not the case right now because shares are down 7% and ARM did guide a little higher. Q4 EPS of the midpoint was 58 cents. The street wanted 57 cents. So really only a 1 cent difference. Q4 revenue guide, $1.47 billion. The street was at 1.44 billion. There is a 19-page shareholder letter. I was trying to skim right now. In that shareholder letter, they said there's strong momentum for AI across every layer of the AI stack from edge to cloud. They said they're going to be separating their business into edge AI, which is smartphones, IoT, physical AI, so auto and robotics, and then cloud AI. And then one line stood out. They said that, with AI, workloads are constantly running, especially with agentic AI, and they're going to be power constrained. They're arguing that's where CPUs will be in top demand. These are central processing units that ARM specializes in, that Intel specializes in, that AMD specializes in. But nonetheless, really, it's another story of just the guide not being high enough for this market. Shares down 8.5%, guys.
I think the most important news of the day, everybody, is really not about Google. Snapchat made some money for the first time. 3 cents of EPS versus expectations of losing 3 cents. They beat by 200%. Snapchat is finally profitable.
No, something's got to be wrong.
Business.
Can you refresh it, please? Something's wrong.
Snapchat made money? Wow.
Is it real money or fake money?
I don't know that much yet. The stock's up 3%, fell below $6 today. But if it's real, if it's actually operating income, then maybe it's maybe it's growing up as a company.
Dude, I can't get over this. This Google, like, employees are going, like, every narrative, they're going to be laying everyone off, and CapEx is going to eat away at free cash flow, and growth is going to slow on Google search. Like, I can't believe we were able to get Google at such amazing deals over the last 2 years. It's just, and now I think that same narrative is going to play out across software. But wow, I love this name.
Yeah, I mean, this was an incredible quarter. As you can see right here, these are the highlights. 60 billion YouTube, 750 million Gemini users, 17% revenue growth, 10 billion tokens per minute, 325 million paid consumer subscriptions. Back in April, that number was 270 million. And then 70 billion annualized revenue run rate. This should also be really good for Amazon, which is going to be tomorrow.
So do they count me as multiple? Like, if I have YouTube Premium and Google One and all of those things, do they count me as multiple users?
I would think so if they're independent, unless you buy the package. I think if you buy the package, you'll be one. If not, you count as 3.
Is there a package that includes YouTube Premium and
Yes,
Google One?
Yeah.
The AI one includes a lot of things.
The AI, the $200 per month one includes that.
Okay, well, I'm just getting scammed then because that's the one I have.
So here's the question. Who's buying the dip? Down 3%. I know 3% isn't really a dip, but let's say this opens down 5 or 6% tomorrow. Let's say it gets back to 300. Based on these numbers, is this a Microsoft where, I mean, I took a shot at it at 413. I think some people bought it yesterday. It got to 408 today. Neil, Sam, any of you guys thinking of buying this dip if we see below 300?
No, Amazon's probably the better candidate when it comes to buying the cloud dip. You know, I'm bullish Amazon mostly because of AWS, and now it's advertising. Google's got that too. And if we compare PE, forward PE, it's Amazon's cheaper. Just how it is.
Is it cheaper on a forward basis? I think they're both 30.
No, sorry, not PE. Forward operating cash flow.
Yeah, they're both relatively the same at these levels. I mean, I think we would have to see a pretty dramatic dip for a lot of people to get excited about Google, but still, if the street takes them down on these numbers, that would be incredible to see.
I mean,
Meta went back to pre-earnings prices because why not, right? I mean, why not? I mean, did you discuss what the heck's going on in the market right now? Because it seems like, okay, low can go lower and just everything gets taken down for like zero reasons.
Yeah, we talked about it in the beginning. Obviously, the SaaS sell-off is a bit weird. I mean, again, what could Google have done that would have been better than these numbers? Maybe spend less on CapEx, but then they couldn't guide the type of revenue growth they're guiding. So at that point, street taking them down on this, I mean, it's almost like they can't win, right? And I think a lot of companies are in this situation right now, which is they're blowing away the quarter, but either they have a high multiple that gets compressed or the street doesn't want to expand their multiple because of some ancillary concern that they seem to have. Here were the earnings, by the way, on Qualcomm, which is also down after hours.
Bottom line posting adjusted EPS of $3.50 on revenues of $12.25 billion. The QCT division, which encompasses hardware, chips, and software, beat expectations, as did their IP business. But you're seeing shares down 6%. And that's because the Q2 guide fell short and memory is to blame. Q2 revenue and EPS had the guidance ranges that fell entirely below consensus. I was able to catch up with Qualcomm CEO who said, quote, memory is going to define the size of the mobile market. Phone makers are just adjusting purchases and inventory based on memory availability and pricing, and smaller manufacturers, especially in China, are going to be impacted by the ability to secure memory. There is a small silver lining, though. Qualcomm is concentrated in premium tier handsets, where the CEO says demand has been, quote, very, very strong, both for Apple modems and within the Android ecosystem. The theory is premium consumers can absorb higher memory prices better than the mass markets. Auto, as well as Internet of Things, also continue to grow, which bodes well for diversification. But you could see the guide right now is really what's hurting shares, down 7%, guys.
All right, Christina, thanks. Christina Parts.
Memory continues to be the bottleneck. Tanner, are you seeing any red flags in this quarter at all? We got the call in about 5 minutes.
The only thing that we have to wait for, it's December, so we don't know, paid clicks change, cost per click change, impressions, any of these things. Most times they talk about that on the call, so that'll be interesting to hear about. And then revenue backlog. So the one thing that was very important last quarter was the massive spike up in revenue backlog. Now, Microsoft just ended up showing off a big increase as well, but it was mainly driven by OpenAI. So then the market just faded all that excitement. But last revenue backlog that they ended up showing was up 81% year over year. I'm interested to see if that growth continues to climb. We've seen from Microsoft, Oracle, any company that's been dealing with OpenAI that, backlogs have just skyrocketed. So I'm curious to see what they say for Q4. But the reason why we don't have that number yet is it usually drops in the call, or we have to wait for the 10Q or 10K this time.
Agreed. I also want to warn people we will be watching the call, but the first 25 minutes are very boring for this call. Like, Google literally reads every single number that they report, almost like on the 8K or something. So it's going to be a while until we get into Q&A, and that's when it'll get better. But I mean, look, each executive should be coming into this call feeling pretty damn bullish about the numbers they put up. that CapEx guide, they're just going to have to explain why. But this is not like Zucks where he has to paint some story about, well, maybe the metaverse. And like, no, we're spending it on cloud because we're growing cloud 50%. Like, it's not that hard to understand why we're spending this money. And I think that might be enough.
Oh, ENS. Did you show ENS showed off earnings?
Yeah. Oh, they had earnings today? No,
yeah,
I didn't.
and Nurses just showed off earnings.
6% down.
Revenue up 1% year over year. Adjusted EPS actually beat, but down 11% year over year. They were expecting negative 272. They got, they were expecting $2.72. They got $2.77. Gross margins are down. The guide doesn't look super great. Capital expenditures for full years, looking at about $80 million.
This name is a cheap name, trades at 2 times sales. It's up like 120% over the past year. It's part of the energy storage, batteries, grid type of area that people wanted to invest in. But obviously they're not growing that much, right? So that's the risk you take.
The story about Enersys is inflecting on accelerating revenue. That's the thesis about it. I mean, you're not buying it for today, and by the time you buy it, when they are accelerating revenue, which they will at some point, then the stock's gonna be much higher.
Yeah,
the reason why trades are cheap. Yeah, same thing with on semiconductor. The thing is like still not decelerating, but revenue is contracting, but it's going to be accelerating for the next couple of years, and that's a bull case of it. If you wait until then, it's going to be way higher.
Agreed. Trying to see some final. We got the call in 2 minutes. Trying to see if there's anything else in the press release that's interesting here. Google now has 96 billion of cash.
Honestly, I think the thing that we're not really talking about, but it's probably the most exciting part, is search is growing at 16.7%. This is once again the fastest they've grown since March of 2022 in search. Like, this is their biggest revenue driver, and the growth rate just continues to accelerate. And this was the part that people thought was going to die, like for real. I think that's probably the most significant.
I do wonder, Tanner, how they're counting, like when you use an AI model and that AI model goes and does like certain searches. I wonder if how they include or exclude into some of these searches overall, because could that just be inflated due to kind of like when you use ChatGPT or something else, it definitely uses some form of AI search.
That's definitely, there's no way we believe that 10 blue links are growing 16% year over year, right? Like, I know they don't break, it has to be some level of AI in that search revenue.
Definitely AI mode and AI overviews is part of that. I don't know if it's for any APIs or anything like this. I don't know if they've confirmed that.
But
I should say I don't know that.
To your point, it's still impressive, right? Because there's still a decent chunk of that PPC pay-per-click advertising that's still growing at a pretty healthy level. These guys have 126 billion in cash, and they did 132 billion of net income, aka profits, in 2025. I mean, some pretty damn big numbers. But yeah, search is growing. Even if AI searches are included in that entire ecosystem, they're doing 132 billion of cash or 132 billion of profits. And I don't think that can necessarily be discounted if we were to see this one go down 5 or 10%. O'Reilly's Auto Parts missed by 1% on EPS. They beat by 1% on revenue.
Those are memory prices.
Exactly.
What's the ticker for that? O'Reilly.
Google's US revenue grew by 17% this year, or year over year. Their European and Middle East markets ended up growing at 17.3%. APAC markets grew at 22.2%, and other Americas grew at 20%.
O'Reilly is down 7%. O'Reilly's Auto Parts on a slight miss and a slight beat. Okay, I think the call is live. The call is live. Here we go. Got about 25 minutes, and then we'll get Q&A.
Reconciliation measures is included in today's earnings press release, which is distributed and available to the public through our investor relations website located at abc.xyz/investor. Our comments will be on year-over-year comparisons unless we state otherwise. And now I'll turn the call over to Sundar.
Thanks, Jim. Hi, everyone. Thanks for joining us. It was a tremendous quarter for Alphabet. The launch of Gemini 3 was a major milestone, and we have great momentum. Alphabet annual revenues exceeded $400 billion for the first time. This quarter, search continued to accelerate with revenues growing 17%. YouTube's annual revenues surpassed $60 billion across ads and subscriptions. Cloud significantly accelerated with revenues growing 48%, now on an annual run rate of over $70 billion. Backlog grew by 55% quarter over quarter to $240 billion, representing a wide breadth of customers driven by demand for AI products. We have over 325 million paid subscriptions across consumer services, with strong adoption for Google One and YouTube Premium. In addition, we have sold more than 8 million paid seats of Gemini Enterprise, which we launched just 4 months ago. And our Gemini app now has over 750 million monthly active users. We are also seeing significantly higher engagement per user, especially since the launch of Gemini 3 in December. Overall, we are seeing our AI investments and infrastructure drive revenue and growth across the board. To meet customer demand and capitalize on the growing opportunities ahead of us, our 2026 CapEx investments are anticipated to be in the range of $175 to $185 billion. Today, I'll provide an update on our AI progress and then share highlights from Search, Cloud, YouTube, and Waymo. First, AI progress across the full stack. Our unrivaled infrastructure serves as the bedrock of our AI stack. We have the industry's widest variety of compute options. That includes GPUs from our partner NVIDIA, who announced at CES that we'll be among the first to offer their latest Vera Rubin GPU platform, plus our own TPUs that we have been developing for a decade. In December, we announced our intent to acquire Intersect, which provides data center and energy infrastructure solutions. As we scale, we are getting dramatically more efficient. We were able to lower Gemini serving unit costs by 78% over 2025 through model optimizations, efficiency, and utilization improvements. Next, world-class AI research, including models and tooling. We offer the most extensive model portfolio in the world and lead across text, vision, and image-to-video LM-Arena leaderboards. Gemini 3 Pro drives the state-of-the-art in reasoning and multimodal understanding. It has seen the fastest adoption of any model in our history. Since launch, Gemini 3 Pro has consistently processed 3 times as many daily tokens on average as 2.5 Pro. Our latest model powers Google Antigravity, our new development platform where agents can autonomously plan and execute complex software tasks. It already has more than 1.5 million weekly active users after launching just over 2 months ago. Our first-party models like Gemini now process over 10 billion tokens per minute via direct API used by our customers, up from 7 billion last quarter. Third, bringing AI to our products and platforms. We are shipping innovation at scale to bring helpful AI features to people everywhere. In January alone, we have launched personal intelligence in AI mode in Search and the Gemini app, introduced new features to Gmail and updated Veo, reimagined Chrome as an AI-first agentic browser through features like Chrome Auto Browse, announced Project Genie, which lets users create and explore interactive worlds generated in real time using Genie 3, our general-purpose world model. And we laid the groundwork for shopping in the AI era by introducing a new open standard for agentic commerce, the Universal Commerce Protocol, built alongside many retail industry leaders. Finally, from Android to Pixel, we are getting our best AI capabilities into people's hands. At CES, a range of partners, including Samsung, showcased how they are bringing Gemini to more devices, from XR to the living room and beyond. And to confirm the rumors, we'll be introducing our Pixel 10a to our best-ever-rated Pixel 10 series very soon. Turning now to key highlights from the quarter, starting with search. Search saw more usage in Q4 than ever before as AI continues to drive an expansionary moment. We have executed with incredible speed. We shipped over 250 product launches within AI mode and AI overviews just last quarter. We have integrated Gemini 3 directly into AI mode in search. Now search can better understand your query, dive deeper on the web, and generate interactive UI experiences. And last week, we upgraded AI overviews to Gemini 3, giving users a best-in-class AI response at the top of the search results page. We have also made the search experience more cohesive, ensuring the transition from an AI overview to a conversation in AI mode is completely seamless. These new experiences are proving to be more helpful and are driving greater usage. A few highlights. First, once people start using these new experiences, they use them more. In the US, we saw daily AI mode queries per user double since launch, and AI overviews continue to perform very well. Second, people are engaging in longer, more complex sessions. Queries in AI mode are 3 times longer than traditional searches. We are also seeing sessions become more conversational, with a significant portion of queries in AI mode now leading to a follow-up question. Third, people are searching in new ways beyond text. Nearly 1 in 6 AI mode queries are now non-text using voice or images. And Circle to Search is now available on over 580 million Android devices. Next, Google Cloud. Our growth in revenue, operating margin, and backlog highlights the strength of our entire portfolio. 1, we are winning more new customers faster. We exited the year with double the new customer velocity compared to Q1. 2, we are also signing larger customer commitments. The number of deals in 2025 over $1 billion surpassed the previous 3 years combined. And 3, we continue to deepen our relationships with existing customers who are outpacing their initial commitments by over 30%. Nearly 75% of Google Cloud customers have used our vertically optimized AI, from chips to models to AI platforms and enterprise AI agents, which offer superior performance, quality, security, and cost efficiency. These AI customers use 1.8 times as many products as those who do not, enabling us to diversify our product portfolio, deepen customer relationships, and accelerate revenue growth. Our product line has multiple monetization levers spanning infrastructure, platform, and high-margin AI-powered products and services, with 14 product lines, each exceeding $1 billion in annual revenue. We offer leading infrastructure for AI training and inference to our cloud customers, with the industry's widest variety of compute options, from our own 7th-generation Ironwood TPU to the latest NVIDIA GPUs. Our 10-year track record in building our own accelerators with expertise in chips, systems, networking, and software translates to leading power and performance efficiency for large-scale inference and training. Our cloud AI accelerators serve the leading frontier AI labs, capital markets firms like Citadel Securities, enterprises like Mercedes-Benz, and governments for high-performance computing applications. We also offer our leading generative AI models, including Gemini, Imagen, Veo, Chirp, and Lyria, to cloud customers. In December alone, nearly 350 customers each processed more than 100 billion tokens. In Q4, revenue from products built on our generative AI models grew nearly 400% year over year, significantly accelerating from the prior quarter. Today, more than 120,000 enterprises use Gemini, including AI unicorns like Lovable and OpenEvidence, and global enterprises like Airbus and Honeywell. 95% of the top 20 and over 80% of the top 100 SaaS companies use Gemini, including Salesforce and Shopify. Gemini is becoming the AI engine for the world's most successful software companies. Leading enterprises are also driving strong demand for our enterprise AI agents. We have sold more than 8 million paid seats of Gemini Enterprise, our enterprise AI platform, to more than 2,800 companies, including BNY and Virgin Voyages, to streamline knowledge management and automate processes. Gemini Enterprise managed over 5 billion customer interactions in Q4, growing 65% year over year for customers including Wendy's, Kroger, and Woolworths Group. Our integration of Gemini in Google Workspace is driving wins with global brands like Schwartz Group and public sector organizations like the U.S. Department of Transportation. We are also seeing momentum with independent software vendors. Revenue from AI solutions built by our partners increased nearly 300% year over year, and commitments from our top 15 software partners grew more than 16x year over year. Before moving on, I'm pleased that we are collaborating with Apple as their preferred cloud provider and to develop the next generation of Apple Foundation models based on Gemini technology. Up next, YouTube. I want to highlight 4 points. First, streaming. In the living room, YouTube continues to be the #1 streamer in the US for nearly 3 years, according to Nielsen. From the NFL to Coachella, YouTube is where people watch today's biggest popular culture moments unfold. Second, subscriptions. We continue to see strong subscription revenue growth across YouTube, particularly YouTube Music Premium. We'll soon launch new YouTube TV plans, bringing more choice and flexibility to subscribers with over 10 genre-specific packages. And the NFL has seen strong NFL Sunday Ticket subscriber growth with YouTube, with the highest paid subscriber number ever in the history of the product. Third, podcasts. To illustrate YouTube's popularity, in October 2025, viewers watched over 700 million hours of podcasts on living room devices, up 75% from just a year prior. And fourth, AI is transforming the YouTube experience for both creators and viewers. On average, every day in December, over 1 million channels used our new AI creation tools to supercharge their creativity. During that same month, more than 20 million viewers used our new Ask tool, powered by Gemini, to learn more about the content they watched. And finally, Waymo. This week, Waymo raised its largest investment round to date and is well positioned to continue its momentum with safety at the core. In December, we surpassed 20 million fully autonomous trips and are now providing more than 400,000 rides every week. Waymo continues to expand its service territory. Its 6th market, Miami, launched 2 weeks ago, and Waymo will soon expand its service to multiple cities across the US and in the UK and Japan. The team has made incredible progress on important capabilities, including opening up public service to airports and freeways. In closing, 2025 was a fantastic year for the company. A big thanks to our employees and partners worldwide. We are really well positioned going into 2026. Now, over to Philip.
Thanks, Ondar, and hello, everyone. I'll cover performance for Google services for the quarter, then structure the rest of my remarks around the great progress we're delivering across search, YouTube, and partnerships. Google services revenues were $96 billion for the quarter, up 14% year on year, primarily driven by accelerated growth in search. Adding some further color to our results. The 17% increase in search and other was led by broad strength across all major verticals, with retail particularly strong. On YouTube, the 9% growth in advertising revenues was driven by direct response. Network advertising revenues were down 2% year on year this quarter. Starting with search and other revenues, which delivered over $63 billion in revenue for the quarter. Sundar mentioned the expansionary moment for search. The same is true for ads. We're investing in AI to drive significant improvements across all areas of marketing. We're expanding the entire playing field that advertisers can compete on. AI gives businesses the ability to reach more customers in more places than ever before. Gemini uniquely positions us to bring the transformational benefits of AI to ads in 3 critical areas for our customers: ads quality, advertiser tools, and new AI user experiences. First, ads quality. We've been deploying Gemini models to improve query understanding at a rate of almost a launch per month for the last 2 years. These improvements drive better query matching, ranking, and quality, making search ads even more effective. With Gemini across our ads quality stack, we evaluate relevance with greater accuracy than with previous generations of models. This has significantly improved our ability to systematically deliver more helpful, high-quality ads, contributing to a meaningful reduction in irrelevant ads served. Gemini's understanding of intent has increased our ability to deliver ads on longer, more complex searches that were previously challenging to monetize. Gemini models also have a significant impact on query understanding in non-English languages, expanding opportunities for businesses to scale globally. Second, we're building more agentic actions into our advertiser tools. Businesses can now leverage Gemini in conversational experiences within Ads and Analytics Advisor to identify and run recommended actions such as generating new campaigns. Advertisers use Gemini as a real-time partner to assemble creatives. In Q4 alone, they used Gemini to create nearly 70 million creative assets via text customization in AI Max and PMax. For instance, Aritzia, Canada's premier fashion house, used AI Max to find new high-value customers that traditional strategies miss, delivering an 80% incremental uplift in conversion value for Q4. L'Oreal, one of the first alpha testers, used AI Max in 2025 across 800 unique campaigns in 23 countries and 30 brands. AI Max enabled the L'Oreal Group to maximize its presence across the full consumer journey, fuel its consumer growth, and increase revenue for DTC brands like NYX by 23%. The third area is how we monetize new AI user experiences in search. We have significantly increased our focus on AI mode and are in the early stages of experimenting with AI mode monetization, like testing ads below the AI response, with more underway. For example, we announced direct offers, a new Google Ads pilot, which will allow advertisers to show exclusive offers for shoppers who are ready to buy directly in AI mode. This new type of sponsored content uses AI to match the right offer provided by the retailer to the right user. As Sundar mentioned, we are building the era of agentic commerce and working with our partners to introduce the Universal Commerce Protocol in our consumer products and across the web. We've received tremendous feedback from the industry. Soon, people can use a new checkout experience to buy directly in AI mode and Gemini from select merchants. Turning now to YouTube, which remains the #1 streamer in the US for nearly 3 years, according to Nielsen. YouTube creators are providing an unmatched breadth of content. Our investment in AI innovation across creativity, viewing experience, and monetization continues to pay off. We're seeing strong traction in our subscription business, are innovating to meet consumers where they are. We added a new sports tier for YouTube TV at a lower price point. YouTube Premium Lite is proving to be a popular choice. And we continue to deliver strong year-on-year growth across YouTube subscriptions, particularly YouTube Music and Premium. Looking at monetization across YouTube, momentum continues in Shorts and the living room. Shorts now averages over 200 billion daily views, and as we've shared before, in a number of countries, Shorts earns more revenue per watch hour than traditional in-stream on YouTube, including the US. The retail vertical continues to grow, fueled by smaller advertisers increasingly adopting demand gen. Likewise, direct response continues to benefit from the momentum we're seeing with small and medium-sized advertisers. Viewers trust product and brand recommendations from YouTube creators, and we're focused on making YouTube a premier shopping destination. Innovations like shoppable ad formats are improving advertiser return on investment. During Cyber 5, advertisers piloted shoppable mastheads, a new interactive ad format where viewers browse products and send links to their phones for an easy shopping experience. On brands, our Creator Partnership Hub makes it easier for brands to find creators and develop campaigns. This holiday season, brands like JCPenney, Old Navy, and Target worked with creators for their holiday campaigns. Mattel partnered with 8 top YouTube creators to reach families during the peak holiday shopping season in a campaign that helped drive a 25% increase in search volume for Uno. As always, I wrap with the progress we're seeing across partnerships, where customers tap into the strength and breadth of Google's products to accelerate their transformation. I would start by joining Sundar in saying how pleased I am that we are collaborating with Apple as their preferred cloud provider and to develop the next generation of Apple Foundation models based on Gemini technology. We partnered with Reliance Jio to provide over 500 million consumers with an 18-month free trial of our Gemini suite of products and 2 terabytes of cloud storage. Reliance Enterprise customers will also get access to Google Cloud's Gemini Enterprise and TPUs, bringing the best of Google AI to every employee and workflow. The Home Depot is applying Google AI across the board, from cloud tools to AI-powered ads, and YouTube creator partnerships that connect with the next generation of duos. Their investments in PMax and YouTube creator partnerships have resulted in double-digit increase in ad clicks and visits. In closing, I'd like to thank Googlers everywhere for their contributions to our success, and as always, to our customers and partners for their continued trust. Anat, over to you.
Thank you, Philip. My comments will focus on year-over-year comparisons for the fourth quarter, unless I state otherwise. I will start with results at the Alphabet level, and will then cover our segment results. I'll end with some commentary on our outlook for the first quarter and full year 2026. 2025 was a strong year of innovation and execution for Alphabet. These efforts, combined with our investments in AI, drove meaningful results across the business. For the full year 2025, Alphabet consolidated revenues were $403 billion, up 15% on a reported and constant currency basis. Moving to Q4 performance, we delivered strong growth in the fourth quarter. Consolidated revenues reached $113.8 billion, up 18%, or 17% in constant currency, and was driven by an acceleration in search and cloud revenues. Turning to costs and expenses, we reported a $2.1 billion stock-based compensation charge due to an increase in Waymo's valuation related to the investment round that was announced on Monday. The vast majority of the charge was reflected in R&D expenses. Total cost of revenue was $45.8 billion, up 13%. Tech was $16.6 billion, up 12%. Other cost of revenues was $29.2 billion, up 13%, with the increase primarily driven by depreciation associated with the deployment of our technical infrastructure, content acquisition costs largely for YouTube, and other technical infrastructure operations costs. Total operating expenses were up 29% to $32.1 billion. R&D expense increased by 42%, driven by compensation and depreciation. The increase in compensation was due to the Waymo charge and investment in AI talent. Sales and marketing expenses were up 12%, primarily driven by marketing investments to support the Gemini app and search. And G&A expenses increased 21%, primarily due to a shift in timing of our charitable contributions. Operating income increased 16% to $35.9 billion, and operating margin was 31.6%. Both operating income and operating margin were negatively impacted by the $2.1 billion Waymo charge in the quarter. Other income and expenses was $3.2 billion, primarily due to unrealized gains in our non-marketable equity securities portfolio. Net income increased 30% to $34.5 billion, and earnings per share increased 31% to $2.82. We generated record operating cash flow of $52.4 billion in the fourth quarter and $164.7 billion for the full year. This translated into $24.6 billion of free cash flow in the fourth quarter and $73.3 billion for the full year. We ended the quarter with $126.8 billion in cash and marketable securities and $46.5 billion in long-term debt. Turning to segment results, Google Services revenues increased 14% to $95.9 billion, reflecting strong growth in search and subscriptions. Google Search and other advertising revenues increased by 17% to $63.1 billion, representing another strong quarter with continued growth across all major verticals, with the largest contribution from retail. YouTube advertising revenues increased 9% to $11.4 billion, driven by direct response advertising. Results were negatively affected from the lapping of the strong spend on U.S. election in the fourth quarter of 2024 that we've mentioned on previous earnings calls. Network advertising revenues of $7.8 billion were down 2%. Subscription platforms and devices revenues increased 17% this quarter to $13.6 billion due to strong growth in YouTube subscriptions, particularly YouTube Music and Premium, and growth in Google One, which benefited from increased demand for AI plans. Google Services operating income increased 22% to $40.1 billion, and operating margins was 41.9%. The Google Cloud segment delivered outstanding results in the fourth quarter as the business continued to benefit from strong demand for enterprise AI products. Cloud revenue accelerated meaningfully and were up 48% to $17.7 billion. Revenues were driven by strong performance in GCP, which continued to grow at a rate that was much higher than cloud's overall revenue growth rate. As Sundar noted, we're driving performance through strong growth in the win rate of new customers, signing larger customer commitments, and increasing spend with existing customers. GCP's performance was driven by accelerating growth in enterprise AI products, which are generating billions in quarterly revenues. We had strong growth in both enterprise AI infrastructure, driven by deployment of TPUs and GPUs, and enterprise AI solutions, which benefited from demand for our industry-leading models, including Gemini 3. Core GCP was also a meaningful contributor to growth due to strong demand for infrastructure and other services, such as cybersecurity and data analytics. We also had double-digit growth in Workspace, driven by an increase in average revenue per seat and the number of seats. Cloud operating income was $5.3 billion, more than doubling year over year, and operating margin increased from 17.5% in the fourth quarter of last year to 30.1%. Google Cloud's backlog increased 55% sequentially and more than doubled year over year, reaching $240 billion at the end of the fourth quarter. The increase in backlog was driven by strong demand for our cloud products, led by our enterprise AI offerings from multiple customers. In other bets, revenues were $370 million, and operating loss was $3.6 billion, reflecting the $2.1 billion Waymo charge I mentioned earlier. We allocate resources in other bets to businesses like Waymo, where we see meaningful opportunities to create value. Alphabet funded a significant portion of the $16 billion investment round that Waymo announced on Monday, which will allow the business to accelerate its global expansion. CapEx was $27.9 billion for the fourth quarter and $91.4 billion for the full year, in line with our expectation. The vast majority of our CapEx was invested in technical infrastructure, with approximately 60% of that investment in servers and 40% in data centers and networking equipment. In Q4, we returned capital to shareholders through $5.5 billion of share repurchase and $2.5 billion of dividend payments. Turning to our outlook, I would like to provide some commentaries on factors that will impact our business performance in the first quarter and full year 2026. First, in terms of revenues, we're pleased with the overall momentum of the business. At current spot rates, we would expect to see an FX tailwind to our consolidated revenues in Q1. However, the volatility in exchange rates could affect the impact of FX on Q1 revenues. In Google Services, we expect growth to be driven by ongoing innovation in the user experience, as well as improved ROI for advertisers, keeping in mind the normal seasonal pattern for advertising revenue. In Google Cloud, we're seeing significant demand for our products and services, which we expect to continue to drive strong growth despite the tight supply environment we're operating in. Moving to investments, the investment we have been making in AI are already translating into strong performance across the business, as you've seen in our financial results. Our successful execution, coupled with strong performance, reinforces our conviction to make the investments required to further capitalize on the AI opportunity. For the full year 2026, we expect CapEx to be in the range of $175 billion to $185 billion, with investments ramping over the course of the year. We're investing in AI compute capacity to support frontier model development by Google DeepMind, ongoing efforts to improve the user experience and drive higher advertiser ROI in Google Services, significant cloud customer demand, as well as strategic investments in other bets. Keep in mind that the availability of supply, pricing of components, and timing of cash payments can cause some variability in the reported CapEx number. In terms of expenses, as we've discussed on previous calls, the significant increase in our investments in technical infrastructure will continue to put pressure on the P&L in the form of higher depreciation expense and related data centers operations costs such as energy. In 2025, depreciation increased by nearly $6 billion, or 38%, from $15.3 billion in 2024 to $21.1 billion in 2025. Given the increase in our CapEx investments in recent years, we expect the growth rate in 2026 depreciation to accelerate in Q1 and meaningfully increase for the full year. We're also planning to continue hiring in key investment areas, such as AI and cloud. In 2025, our teams delivered amazing innovation, executing with a high level of discipline and velocity. These efforts provided great experiences for consumers and outstanding performance for creators, partners, and enterprise customers, driving strong revenue growth. I want to take this opportunity to thank our employees for their contribution to this impressive performance. Now, Sundar, Philip, and I will take your questions.
Thank you. As a reminder, to ask a question, you will need to press *1 on your telephone. To prevent any background noise, we ask that you please mute your line once your question has been stated. And your first question comes from Brian Nowak with Morgan Stanley. Your line is now open.
Thanks for taking my questions. I have two, one on Agentic, one on YouTube. The first one on Agentic, Sundar, I'd be curious to hear about, as you look back at 2025, where do you think you made the most progress on new types of Agentic commerce products? And then looking into 26, where are you most optimistic to sort of have even more progress and utility for users and your advertisers? And the second one is on YouTube. You know, we've seen a lot of the new content creation models like Genie, et cetera. Walk us through sort of the Alphabet long-term vision for how Genie and some of these content creation tools could be integrated into YouTube over time.
Great. Thanks. Thanks, Brian. First, maybe I'll take the agentic part first. You know, I definitely think 25 was more about laying the foundation, you know, getting the models to start being more robust in agentic use cases. And, you know, obviously coding is the area where, you know, the progress was the most felt. In areas like commerce, I think we spent the year working with the ecosystem to develop the underlying protocol that's going to be needed for this agentic world. So I think the launch of Universal Commerce Protocol at NRF in January with a bunch of partners, founding partners, I think has been super well received. So I'm excited now that we've laid the foundation of interoperability on which agentic commerce can work. And now we are integrating those experiences into Gemini, AI mode, and so on. So I think this is the year where you will see consumers actually being able to use all of this, and I'm excited about the opportunity ahead. On YouTube, look, super excited by Genie. I'm blown away by, you know, spent a lot of time creating this incredible worlds. I think it's going to have a wide level of applicability. I think area where we shine in general is multimodality and representing the real world. And I think Genie is a further step in that direction in terms of building world models. All the innovation we are doing, be it our Imagine, Veo, Lyria, Genie, all that work we bring into our products and to our cloud customers. And YouTube is going to be a natural place for creators. We are going to keep incorporating these tools. Already creators are responding by adopting these, but we do want to put creators at the center of the experience. And that's very, very important to us. So it's for us making sure YouTube is a voice for creator expression is the foundation by which we will approach this.
Great. Thanks, Sundar.
Your next question comes from Eric Sheridan with Goldman Sachs. Your line is now open.
Thanks so much for taking the question. Two, if I could. Over the last couple of earnings calls, we've talked a lot about imbalances between demand and capacity for AI, both internally and externally. With the step function change in absolute capital dollars you're projecting now in 26, can you talk about the pathway to closing the gaps for the need for compute, both internally and externally, and how to think about some of the outputs of closing that gap as the year progresses? And again, the second part would be against that level of spend that you're now projecting for 26. How do you think about continuing to find operating efficiencies inside the business to fund those growth investments as well? Thank you.
Thanks, Eric. You are right, and we've been supply constrained even as we've been ramping up our capacity Obviously, our CapEx spend this year is an eye towards the future. And you have to keep in mind some of the time horizons are increasing in the supply chain, etc. So we are constantly planning for the long term and working towards that. And obviously, how we close the gap this year is a function of what we've done in the prior years, right? And so there is that time delay to keep in mind. I expect, the demand we are seeing across the board, across our services, what we need to invest for future work for Google DeepMind, as well as for cloud, I think is exceptionally strong. And so I do expect to go through the year in a supply-constrained way. And maybe Anat can touch on the second part.
Sure. Thanks, Eric, for the question. I've mentioned on one of the previous earnings call our approach to how we look at efficiency and productivity. And we don't view this as an episodic one-time project or effort, but rather how we run the business on a regular basis and always seek additional opportunities to drive efficiency across the business. And certainly with the demand we're seeing, whether it's from external customers or across the organization, the more capital we can free up within the organization to invest, the better we can turn this flywheel of making investments to drive future growth. And we're doing this across the organization, whether it's within our technical infrastructure. Certainly when we invest at these amounts, we look at how we can ensure that we are the most efficient with every dollar that goes towards our technical infrastructure. There are scientific innovation that are part of that process. Technical innovation, as you know, and we've mentioned before, we primarily focus on construction of our own data centers. We do partner with some external parties on lease on occasion, but most of our data center we construct ourselves, and we ensure that we do it in the most efficient way, in a way that matches our workloads and our needs. We look at coding productivity that Sundar mentioned in the past. Are about 50% of our codes are written by agents, coding agents, which are then reviewed by our own engineers. But certainly it helps our engineers do more, move faster with the current footprint. We look at how we run the business across the organization. So using AI within the business to drive daily operations. It can be all the way from the engineering team to small teams within our back office. Even within my finance team, for example, we deployed agents within our treasury organization. We're deploying agents within how we pay and reconcile invoice, et cetera. So there are opportunities across the business that we evaluate on a regular basis to ensure we can free up more of that capacity to invest in our future.
Your next question comes from Doug Anmuth with JP Morgan. Your line is now open.
Thanks for taking questions. I have two. Over the last couple of years, we've seen considerable large language model leapfrogging, and many expect that to continue. What are the ways that Google can build and maintain its Gemini position around data and distribution and product integration? And then how should we think about the potential for TPUs to move outside of Google Cloud and into external data centers and develop as an incremental revenue stream? Thank you.
Doug, look, I think the LLM frontier, it's been an exciting trajectory, and I think 2026 will continue to show that progress. We're obviously improving these models across many paradigms, right? On pre-training, post-training, test time compute, and so on. And we are bringing multimodal models into the picture. We are bringing agentic capabilities. The coding area is showing a lot of progress, and obviously integrating all of this together and offering a great customer experience through our products as well as through our APIs to our cloud customers. To me, feels like there's a lot of headroom ahead. And as you've seen our trajectory over the past 2 years in terms of how we've been making progress, I think we are in a very, very relentless innovation cadence, and I think we are confident about maintaining that momentum as we go through 26. In terms of TPUs, I would think about it as it's reflected in our overall part of what makes Google Cloud an attractive choice is the wide choice of accelerators we bring to bear here, and we meet customers in terms of what their needs are and the choice, as well as other things we bring as part of Google Cloud, the end-to-end efficiencies in our data centers, all of that comes to bear, and that's what you see in the strong momentum in Google Cloud. And given the overall investment we are making, we expect to be able to drive that momentum there. So that's how I would think about it.
Thank you, Sundar.
Your next question comes from Mark Mahaney with Evercore. Your line is now open.
Thanks. Two questions. One, could you just comment a little bit on the YouTube ad revenue, that 9% year-over-year growth? It sounded like direct response was good, and it sounded like from search that retail came in relatively strong. So it's a little surprising that didn't kind of come through in the YouTube ads revenue growth. And then Sundar, can I ask you to try to get ahead of a debate in the market, which is there's kind of maybe at a DeepSeek moment again. You talked earlier about Gemini being the AI engine for some of the most successful software SaaS companies out there in the world, and it just seems like there's a market belief that these software companies are kind of losing seat power, losing pricing power, and it looks like it'd be a really terrible customer base. I can't imagine that that's actually going to happen, but could you just talk about it? You're at the forefront of AI and the impact that that's having on software companies. Why wouldn't that be, or why would it be undermining the economics of your large software SaaS company base? Thanks.
So Mark, first of all, thank you for the question. For the full year 2025, our YouTube's annual revenue surpassed $60 billion across ads and subscription. In Q4, YouTube ads was driven indeed by strong growth and direct response. On the brand side, as Anat shared, the largest factor negatively impacting the year-over-year growth rate was lapping the strong spend on US elections. We also saw a slight impact in some other brand-related verticals. But taking a step back, I think it's important to think about YouTube ads and subs holistically, because when a user shifts from being an ad-supported user to YouTube Music and Premium customer, it has a slightly negative impact on YouTube ads revenues, but a positive impact on our business. And we had strong revenue growth in YouTube subscriptions this quarter, particularly in the YouTube Music and Premium category. Maybe the interesting part is what we're actually excited about, our roadmap in brand, the opportunity on connected TVs, more innovative ad formats. For example, the shoppable mastheads I spoke about earlier that we piloted during Cyber 5. We're working really, really hard to further connect brands and creators, scaling sponsorships, and enabling advertisers to showcase their products, their services during high visibility spotlight moments. We continue to expand the functionality of the Creator Partnership Hub, making it a lot easier for brands to actually find creators and develop campaigns. We're heavily focusing on brand deals, on measurement efforts. So there's a lot of interesting work in the pipeline. And on top of that, we actually see opportunity also for upside with performance advertising. There's a lot of momentum with demand gen adoption across small and medium advertisers. We're also excited about the opportunity for continued ads innovation and direct response, like, for example, shoppable formats, including in the living room, which is then helping drive strength in retail, the continued momentum in shorts, and so on. So overall, we're quite excited. Yeah.
Great. And Mark, on in terms of Gemini adoption and how what this moment means for SaaS, etc. Look, at least from my vantage point, I definitely see we have very, very good SaaS customers who are leaders in their respective categories. And what I see the successful companies doing is they are definitely incorporating Gemini deeply in critical workflows, be it on improving their product experience and driving growth, or using it to drive efficiency within their organizations. And I think it is an enabling tool, just like it has been an enabling tool for us across our products and services, be it search, YouTube, etc. I think the companies who are seizing the moment, I think, have the same opportunity ahead. And at least we are excited about the partnerships we have there, and the momentum. If I look at it in terms of their tokens usage, etc., the growth has been very robust in Q4.
Thank you.
Your next question comes from Mark Schmulik with AllianceBernstein. Your line is now open.
Yes, thanks for taking the questions. Two, if I may. The first for Anat is, can you talk a little bit more about the relationship between investment levels and how you kind of expect core performance to trend? Is there like an operating income or a free cash flow objective that you solve towards, or how do you think about greenlighting resources and projects? And then the second question for all of you, a year ago, we probably could have guessed the answer to this question. But given where we are today, for each of you, what keeps you up at night here as you think about the Google story and what's next? Thanks.
Thanks, Mark. Let me start with a question on the investment framework, and it's an important one, and as you can imagine, an important one for us as well. We have a highly rigorous framework that we use internally where we look at all the needs for investment, whether it's from our own organization or from external customers, and have an estimate of what that investment could potentially yield, obviously not just near term, but long term as well. So we take that into consideration when we make the following decision. The first one is the total investment that we make across the company. This was, for example, in 2025, the $91 billion we invested in CapEx, and our estimate for CapEx investment this year. So what's the total envelope that we want to invest to ensure that we can drive both near-term and long-term growth for the company? And then the second way we use that framework is to just allocate these funds across the organization, determine where we should make these investments. And throughout the year, as you can imagine, we always look to understand where things are moving, whether it's the external dynamics or internal dynamics. And I've mentioned some of the supply chain pressures we're seeing externally. So we look at this with a highly rigorous framework to make sure that we're making the right decision. It was exciting to see the fact that we're already monetizing, and you saw it in the results that we've just issued this quarter, the investments that we've made in AI. It's already delivering results across the business. I know in cloud, it's very obvious external, but you've heard the comments on the success we're seeing in search, the comments from Sundar and from Philip, and then the frontier model development that really serves as the foundation for the organization. We then also look at just the cash flow generation, the health of our financials and the balance sheet. That's important as well. So we take that into consideration when we make the decision about the overall level of investment. We want to make sure we do it in a fiscally responsible way and that we invest appropriately, but we do it in a way that maintains a very healthy financial position for the organization.
And yeah, maybe I can answer on what keeps us up at night. Look, I think overall we've been on this AI first trajectory for over a decade now, and it's what we've been methodically thinking our way through. It's the reason why we've been working on TPUs for over a decade, as an example. But I think specifically at this moment, maybe the top question, is definitely around compute capacity, all the constraints, be it power, land, supply chain constraints. How do you ramp up to meet this extraordinary demand for this moment? Get our investments right for the long term, and do it all in a way that we are driving efficiencies and doing it in a world-class way. And so that's where I think we are meeting the moment well, and but it's definitely an area where I'm spending a lot of time on.
Your next question comes from Michael Nathanson with MoffettNathanson. Your line is now open.
Thanks. I have one for Sundar and one for Anat. Sundar, you mentioned Universal Commerce Protocol a bunch of times. I wonder if you could spend some time talking about the rationale for developing it, the opportunity that you see it solves for, and what it means for the product discovery funnel for consumers. And then for Anat, any color you can provide on a CapEx guide between longer duration assets like buildings and infrastructure and shorter cycle assets like technical equipment. That'd be helpful. Thanks.
Thanks, Michael. Obviously, people go through a lot of commercial journeys across many of our surfaces, search, YouTube, Gemini app, and so on. So I think there's, as well as we support through cloud and ads our entire retail partners as well. And the opportunity to improve the experience, I think can be a kind of a huge foundational uplift here. But it's important to be approaching it keeping in mind that our users, as well as merchants here, and figuring out that value. Part of what's been good in designing the Universal Commerce Protocol is it makes it much easier for users to complete transactions, but at the same time, it allows merchants to help showcase the range of their offerings if they want to make promotions, etc. So all of that is built into the protocol. And I think you have to get that value prop for the ecosystem right to make the experience better. And so it's foundational. And more importantly, we are now implementing the protocols, and our Gemini models are making progress in those agentic capabilities. And I think so I'm excited about a future where, as people are going through discovery, searching, finding new things, if they're interested in acting upon it, all of that is seamless. And so it overall creates an expansionary moment.
And the question with regards to the CapEx and the kind of what makes up the total that we've announced for this year and last year, approximately 60% of our investment in 2025, and it's going to be fairly similar in 2026, went towards machines, so the servers, and then 40% is what you refer to as long duration assets, which is our data centers and networking equipment. And I think you're probably referring to the depreciation delta between them. Those long-term duration assets depreciate over, the building could be 40 years or longer. Other components may be less than that. Another important component is how we allocate this CapEx. And we've commented in the past about the allocation of our ML compute across the business. And for 2026, just over half of our ML compute is expected to go towards the cloud business.
Thank you so much.
Your next question comes from Ross Sandler with Barclays. Your line is now open.
Great. Just a question on the native Gemini 750 million. So we added 100 million MAUs in the fourth quarter. Could you just talk high level about usage and retention of native Gemini? And is this 750 the right way to measure your progress against companies like ChatGPT, or is there another cohort of users that aren't in that 750 that maybe we should also consider? Thanks a lot.
Ross, I think we definitely saw, I would say, extraordinary period of growth in Q4 for Gemini app. It's not just the growth in monthly active users, but there is definitely, there was a sharp increase in engagement per user on the app. So all the metrics, be it active usage, the intensity of usage, retention, all showed distinct progress across iOS, web, Android, etc., and geographically globally. So it definitely all the product experience improvements, the work we did with Nano Banana, the progress with the Gemini models, all translated into strong momentum. And that momentum, is continuing. So we are excited about that, and we'll continue to invest. Obviously, there are many people who are getting a deeply AI native experience in the context of AI mode in search as well, and we are definitely seeing strong growth and progress. And the introduction of Gemini 3 in AI mode was a very positive driver as well. And obviously, we'll continue to evolve these experiences, and I'm excited about the opportunities there.
Thank you.
Your next question comes from Ken Gawrelski with Wells Fargo. Your line is now open.
Thank you very much. Two, if I may, both on search. First, could you walk us through how you are evolving your views on the monetization of AI search activity, given the more conversational nature and longer periods of engagement per session? consumer utility increasingly is increasingly driven by the on-platform results, not specifically the link outs and referrals. In that construct, how do you think about increasing the revenue opportunity to match the consumer utility? Is this increasingly where premium subscriptions play? And then question two, and it's related. As you think about partnerships such as the new Apple partnership on Siri, how do you think about the right way to align for success with those partners? Previously, as disclosed in the DOJ documents, et cetera, it was a revenue share relationship. But now, if you think about the utility that you're driving through AI search and through Gemini on those platforms, it may be less related to the actual search, quote unquote, search revenue. Could you just talk a little bit about how you align with partners for success there? Thank you.
So first of all, it may be worthwhile to say that the acceleration we saw in the search was not due to a single driver, but was really the result of many different parts of our business showing strength and working well together. And maybe I quickly add the vertical perspective: retail, finance, health drove actually the greatest contribution to search revenue, though nearly every major vertical actually accelerated in Q4. More specifically to your question, the ongoing innovation is, as you know, core to what we do, and the enhancements to the user and the advertiser experience really continue to drive our performance. And we make hundreds of these changes every quarter. We see AI overviews and AI mode continue to drive greater search usage and growth in overall queries, including important and commercial queries. Gemini-based improvements in search ads help us better match queries and craft creatives for advertisers. I talked about the understanding of intent and how this has significantly expanded our ability to deliver ads on longer and more complex searches that were frankly previously difficult to monetize. AI Max, for example, is already used by hundreds of thousands of advertisers and continues to unlock billions of net new queries in that sense. We see strength with SMB advertisers expanding their budgets and adopting automation tools, leading to better ROI. On the creative side, we're using Gemini to generate millions of creative assets via text customization in AI Max and PMax, and so on. So we're very pleased with what we're seeing here.
And our last question comes from Justin Post with Bank of America. Your line is now open.
Great. Just want to follow up on the Gemini app. Obviously, great growth there. Are you seeing any cannibalization of search as far as activity as people start using that app more? And then second, on monetization, where are you on that? And with agentic and other ads coming, could that be incremental to your growth over the next few years? Thank you.
Right now, overall, I think we are giving people choice. People are obviously using search, experiencing AI overviews and AI mode as part of it, and Gemini app as well. And the combination of all of that, I think, creates an expansionary moment. I think it's expanding the type of queries people do with Google overall. And so overall, some of it all is what we see as a growth opportunity. And we haven't seen any evidence of cannibalization there. And maybe Philip can comment on the monetization.
Yeah, I think Sundar previously commented on agentic and how we think about it. And look, in general, as with all of our products, we really focus first and foremost on creating a great user experience. And we're very excited about where we are with the ads and AI overviews and early experiments in AI mode, including innovations like direct offers and our roadmap for the future. In terms of the Gemini app today, we are focused on a free tier and subscriptions and seeing great growth, as Sundar discussed. But ads have always been part of scaling products to reach billions of people. And if done well, ads can be really valuable and helpful commercial information. And at the right moment, we'll share any plans. But as we've said, we're not rushing anything here.
Thank you. And that concludes our question and answer session for today. I'd like to turn the conference back over to Jim Friedland for any further remarks.
You don't want any further remarks?
I mean, the further remarks are just like legal things, right?
Well, I mean, I don't know.
Let me go back.
Anthony Noto sometimes wraps it up with a, hey,
let's see.
Fresh horses.
Thanks everyone for joining us today. We look
All right.
forward to
Well-
speaking with you again on our first quarter 2026 call.
Okay, dude. Not all the time. Okay.
Are you happy, Tanner? Those are your...
I'm just saying, maybe they do a little outro. Hey guys, it's we got a lot left to go. Okay.
But did you want him to say, guys, buy the stock? It's dumping after hours. What's going on?
I mean, I wouldn't have complained.
He's going to say Sam Altman and pay off the poly market odds for what he's going to say in the call. That's what he's probably going to do. Congratulations to Oh No 151. You just won $10 million in your odds.
All right, Jose, let's start with you. Thoughts on the earnings?
Thoughts on the earnings. I like the cloud growth, like Tanner mentioned at the beginning, 48% growth. I mean, CapEx was great to hear. They did talk about, there was an analyst that asked the question if they think they're going to be compute constrained after all this CapEx spending. And they said, yeah, I mean, they still believe to be compute constrained. That's where they're kind of investing all this money. And the other good point that I really liked is someone asked, what keeps you up at night? And Sundar mentioned that it's right now is definitely the AI constraints, the chips, the power, the land. That's what's keeping him up at night to make sure he's able to continue to invest and be able to provide an efficient plan for both Google as a business and obviously for the shareholders. So I like the earnings. I mean, with the sell-off happening in the overall market, it's a little bit different from Microsoft. I did buy like the Microsoft dip, but at that time, nothing else was dipping. Even though Google is dipping on this, I think there's still a lot better opportunities maybe out there for some of the AI ecosystem that I like. So this just confirms that thought process that I have. Like AI stocks are selling offshore, but it doesn't make sense. Everybody's telling me that AI is what's keeping them up at night because they can't spend enough money.
Dude, he even gave the SaaS names quite a good remark there. He was like, from what we see really strong SaaS companies that are coming in and actually just using our tools. Like they have no problems leveraging Gemini and essentially turning these SaaS names into AI native businesses.
Tanner, what did you think of the call? I mean, I think every answer they gave to the questions justified the CapEx spend and continued to explain the extent of the business opportunity here. But do you think there was any missed opportunities or something they needed to do a bit better on?
No, I was pretty happy with the call. They highlighted Waymo. They talked a lot about NVIDIA and how they said they'll be first to get the Vera Rubin chips as well. CapEx is highly needed, and they're seeing customers that are just with an insatiable demand. There was a part, I didn't have the transcript in front of me, but I heard something along the lines of like 1/3 of their AI searches are not even text-based. Something crazy like that. I thought that was an interesting stat.
That might
Say
be
that
more. Again? I think you're right. I'm forgetting exactly how they described it, but you're right. They were trying to say they have a diversified view of how people are using Google search at this moment.
Yeah. So the number of deals in 2025 over $1 billion surpassed the previous 3 years combined. We're winning more new customers faster, and we exited this year with double the new customer velocity compared to Q1. Okay, 1/6 is more reasonable.
Voice or image. Yeah. So it was Neil, how about you? I think they justified their CapEx pretty well. But it seems like that's what the street's upset about. Any thoughts on that?
I mean, I guess if you look at Google, why the stock is down, probably it has nothing to do with the results. Even with CapEx increasing, we just talked about it before. CapEx increase, yet free cash flow is flat for the year. So why wouldn't they increase if they see the demand, that the demand is there, the return on investment for them is there? I think the stock is just down right now because it is one of those names that is extremely close to all-time highs. I don't know what the technicals say, if it's still overbought or not, but maybe it's just Google cooling off a little bit. Everything in this report just screams this is, what is the 4 trillion something? Maybe it could be 5 trillion a year from now, I don't know. But the trajectory that they're on right now, if we go back to when BART was released, and then we fast forward to today, it's insane what they're doing inside the company. They talked a little bit about the YouTube ads impact, and they're like, when people go from free to paying users, so of course it's bad for the YouTube ads, but it's a positive impact for our business, which makes sense if you look at the subscription revenue that has increased. I mean, that alone is also an incredible business for them. Waymo, of course, we know Waymo is, let's call it, a semi-standalone company with its own co-CEOs, but it would be nice if they started to share a little bit more on Waymo, because it is valued at $125 billion, which is a bit, I mean, it's a hefty price to pay for a company that's supposedly generated, I don't know, $300 million in revenue or something like that. Uber generated over $50 billion, and that's worth barely, $20 billion more than Waymo. But yeah, all in all, incredible quarter, good call. If the stock is down a little bit, I mean, everything's gone down right now for no good reason. So it is what it is. Plus also the comments they made on the software companies, right? The fact that software companies are using Gemini, things like that. Palantir basically showed this already, right? Because you use Palantir, you're doing more with less. Your company is becoming a better company, more profitable, you're moving faster. So essentially all of these software companies are supposed to feel the same thing. They're supposed to be moving much faster. They're supposed to be profitable, keep their margins. Some will maybe not survive because maybe those are feature companies. I do think that feature companies are going to be in trouble, but the platform companies, the infrastructure companies, I think should be doing well in the future.
For real though, why do you guys think it is coming down? Because it's not like if there was concerns about this name, like we knew that before earnings, right? So what did we see that's actually the market is picking apart? Is it the CapEx raise, regardless of the cloud customers being there? It's just worries that maybe some of those deals end up getting canceled, or maybe potentially are not real, or being written by customers that might go belly up. Like, is that what the market is picking apart right now?
I would think so, Tanner. I mean, 100. If the street was expecting 115, and they're doing closer to 180, is like we still have so much fear of AI not we, but like in the perspective of the market is you have fear of like OpenAI dying, you have fear of software being eaten up by AI. So then you say, if there's this fear, who's going to be actually buying this cloud, and why are they kind of going this overinvestment? Because 115 billion, I think what they expected was still a massive, a strong growth on the sequential, on a year-over-year basis. So I think it's just a fear of like, are we now at the tippy top of this AI bubble, of this AI investment? I don't think so. But if I had to choose one, I think it's just the fear of what are they going to do with the $180 billion? We see the growth in cloud, but like 180 billion is a lot to spend in 1 year. Even though I'm enjoying it, but I just want to give the perspective of what the market, I think, could be thinking.
Last year's was 90 billion, right? So they're essentially guiding for double.
Can we talk about that? What are they going to do? Is it old GPUs?
60% services, 40% data center.
Okay, so it's all. What do you mean by services exactly?
Services and search. So anything that will really propel that. So I don't know if data center. I think data centers involved with their own build out of data centers, and the 60% would be like TPUs, because that's attributing directly to search and services.
Yeah, but build what?
Okay, so it seems like that's how they're going to break it down. Like the
servers and
data
machines.
centers. Yeah, 60% is going to go for like their core search business, and the 40% is going to go for their Google Cloud business. So that's how they're breaking it up first. Then in form of spending $180 billion, I think it's reported like at least 60% is the AI GPUs. The other 40% could be like the land and everything. But I think it might even be higher, depending on the mixture of TPUs and GPUs and everything. But I actually like that 60% search and 40% Google Cloud. But then I guess that gives you the reason of why maybe Search, I'm going to guess, is ads. You can see why Meta is also investing like crazy, right? Because most of the money seems to be going on the advertisement side. If only 40% is going to go to the Google Cloud side.
Also, Neil, bro, you're in the chat. Like you're on the you could say this.
he's probably.
But you guys are talking, so I'm like searching through the transcript to find whatever's useful, and you guys keep talking. I just keep copy pasting in the chat.
This has to be bullish for Nvidia and AMD. Like Meta, Google are beating CapEx estimates by over 50%. There's just no way. I mean, Nvidia stock could go down for whatever reason, but there's no way this is not going to be a year where Nvidia once again beats all the estimates.
I don't think so.
I mean, Supermicro reported earnings yesterday with $12 billion in revenue. Obviously, gross margin sucks for them, but it's just an indication of the AI servers that were shipped this quarter. Microsoft, their CapEx just sequentially, I think, grew by like 70, 80%. This past quarter, they did $30 billion. I don't know. Make it understand why the stock market, why AI stocks are down. I don't get it.
Wait. Supermicro reported $12 billion in revenue in one quarter?
Yeah, and that's yesterday they reported 12 billion. Yeah.
I've never had my portfolio go down so much, but me feel so rich based on this Nvidia news. I feel like I've made all the right calls, yet my portfolio is burning alive. We'll see how it plays out by the end of 2026, I guess.
I agree. Waymo, I also agree. The funding round is a bit aggressive, but nonetheless, if they can keep growing the way they're growing, maybe they're going to be able to expand that. Search continues to grow at a pretty unprecedented pace. Cloud, again, 40% revenue growth. That was incredible. Operating margins, once again, Tanner mentioned, I think this is the best revenue growth we've seen in the past couple of years for Google overall as the business. To answer your question, Tanner, I think the stock is down because everything took a beating today. And it's just, and it kind of scares me for Amazon tomorrow because I think they're going to crush it. But I mean, how much do you need to crush at this point for the market to even kind of give you a little momentum? If 48% cloud growth is not enough, then I don't know what is.
Yeah.
Sam, any thoughts on the quarter?
I mean, great numbers as usual, but I think the real issue here is Warsh. If he ends quantitative easing, that's tightened fiscal policy. It's tightened liquidity in the system. And that's a lot of money not being lent out. And ultimately, high debt companies get hit first. I think that's like the biggest issue in all of this. Like, obviously, AI is not an issue. That's something that's going to be regressing for decades. And even Trump's deal with or talk with Xi Jinping this morning, like, market just sold it off. The overarching thing that's been sticking around for a long time that is massive uncertainty is Warsh going to end QE or not? Like, he's probably going to cut rates, but Fed balance sheet expansion is much more important than rate cutting because you're literally talking about putting liquidity in the system, printing money. And you turn off that money printer, I don't care how good of a company you are, you're going to go down.
Way to put cold water on the party. Like, wow, you're fun.
That's just don't fight the Fed, right? Just don't fight the Fed. That's it.
Yeah, but we didn't have quantitative easing for 3, 4, how many years now? And still we had a nice bull market.
Because the market will bet on what's going to happen, not what did happen or is happening. They're betting on what's going to happen, right? And the market hates uncertainty right now. So they had certainty that we are going to go back to cutting rates. We are going to start the money printer, which Powell did, started at $30 billion. I forget if he increased it in the last meeting, but Warsh comes in, dude's like a super hawk, right? He had multiple speeches of saying that he will only print money when we absolutely need to, right? Not the economy is growing at like 5% plus, $40 trillion economy going at 5% plus. We need to turn on the money printer. Like, from his speeches and his lectures, whatever, he doesn't want to do that. And Warsh came up like, what, a week ago? Now the market's been down since. It's been selling off everything. Every rip, everything just been selling off.
Yeah, but the market's software names, a lot of the names have been selling off since October, even after they said QT is going to end and unofficially QE is starting, because officially it didn't start. And yet software names and some of the tech names anyways went down. Plus, I mean, his way of thinking about it is not such a bad thing, right? The Fed shouldn't be in the headlines every single time. They shouldn't be printing that much money. So technically, it's a good thing for the economy, might not be a good thing for stocks that, of course, need the liquidity and the markets that need the liquidity. Yeah. But I think the market overreacts. I think he was like, oh, the hawkish Fed. First of all, he might not even make it in May. You never know what might happen. But I think they overreact. I think it's not the end of the world. It's not like we need that much liquidity anyways.
Yeah.
But yeah, you're probably right that this is why the market right now is a bit in an uncertain
But even if it wasn't Warsh, I mean, history says that the market always tests a new Fed every time. So like, you know, maybe this is a little bit of short-term pressure.
Do we still believe there's a Trump put on this market? Because that's the real question, right? Like, how low do we go before Trump says it's time to buy the dip, folks? Especially on a midterm year.
We gotta wait for the tweet.
Yeah, the fact that no one knows is probably what's causing the market to be choppy as hell, because like no one knows yet. Like you could, if we knew we were going to get Kevin Hassett, we knew we were going to get Rick Rader. The dude would like unbutton a couple of buttons on his shirt, and the market would probably gap up like 5%.
But Sam, yeah. why do you think Trump picked Warsh then, if he knew Warsh was super hawkish?
I wish I knew, and I think the fact that a lot of people don't know is what scares the market, because people don't know, right? If he keeps on saying Warsh is going to lower rates, but like the market doesn't care about that. It doesn't. I think there's a connection between Bissent and Warsh and the trifecta Stanley Druckenmiller. They've all worked in M&A. They've all had some background in Wall Street, and they all agree that, look, short-term pain for long-term gain, as Tanner and Neil were saying, like, look, this is obviously not the worst pick ever, right? But he's going to do what's right. And we got to deal with this now and deal with it later. But Warsh is like, I don't want to deal with this later. I want to deal with this right now. The question is, how is he going to deal with it? And that uncertainty is what is causing stocks to be stagnant since October. Not everything is stagnant since October. Like the SPY is higher, Qs is somewhat higher. You know, the mega caps are pretty much nearly flat since then. Except for Google, of course. Google is higher. But if everything else
is going to be as hawkish as you're saying about QE, I don't know if gold and silver continue their rally either.
Yeah, no, they're not.
They're going up because we're printing infinite amounts of money. If Warsh turns off the money printer, even if he lowers rates, gold and silver should not be in a super cycle.
They won't be. That's the thing. They won't. And Bitcoin is going to go lower, unfortunately. I think is that I think some people know. People always know ahead of time, you know, whether they hear whispers or whatever, or whether they have access to Trump in the back office or anything like that. People always know ahead of time. And maybe that's the reason why he was selling out for a while, but we don't know. The only thing is that, like, dude, I mean, at the end of the day, like, I'm looking at the index chart, you know, and SPY's like 1% from all-time highs. So I can't be like, this is so bearish right now, because I mean, we're at all-time highs. Like, it's just, you know, there's no way to know. We just have to react based on it. But in the long term, like, AI is just getting started. You know, it's going to be fine. At the end of the day, Warsh comes out and just like, I'm going to wait and see. The market's going to gap up.
Trump says he thinks Warsh understands he wants lower rates, would not have gotten the job had he wanted to raise rates, as per the latest NBC interview.
I mean, they always try to compare to Alan Greenspan at the end of the 90s, right? I think he is going to do the same thing. He's just going to let the economy do its thing, and the Fed will clean up house or clean up the books. And he won't interfere with the growth that we're seeing now with AI, because I think the last big interview at the Reagan Institute, I think last year, he talked about AI, the growth. He even talks about Bitcoin. So I don't even know why Bitcoin and crypto is down, because he seems to be someone that likes it. So it's not going to interfere with the economic growth that we should be experiencing from AI. But since the market doesn't like uncertainty, I guess I still find it very strange that the guy didn't pop up on TV for the last couple of days. Maybe he can't. I don't know what the rules are, but
Wash.
yeah. Once we get a little bit more information, maybe from him, I guess the market can chill out a bit.
I don't know. The market hasn't gone anywhere in 3 months, 4 months.
So big tech earnings after tomorrow, basically over until we get NVIDIA, which is about 3 weeks from now. Amazon's probably going to crush. I doubt anyone here thinks Amazon's not going to do well. So Max 7 did what they needed to do this quarter. I think Meta was the one we were the most scared about, and Meta crushed. I mean, I feel like now it's up to the market to figure out.
Neoclouds, Iron is reporting tomorrow. Then we have CoreWeave, Nebius, and all the rest. I'm quite curious what they're going to do. But yeah, so far so good, right? So far, I think earnings were beats mostly across the board.
Do you guys look at the Google Clouds and the Microsofts, potentially AWS, as being bullish or bearish on the neoclouds? I think immediately you would say this is, of course, bullish. But do you think that this means that the larger names can actually handle the amount of demand that the market is putting up, or there's just so much that everyone is essentially going to see increased growth rates?
I would say with the capex they're giving, I think they're including deals that are going to have to be made with these kind of neoclouds. In the short term, Tanner, I'm bullish AI infrastructure plays like neoclouds. I think in the long term, when kind of that demand starts to slow down, that's going to be one of the trickling fights, and that's when you're going to get kind of like margins. But I think right now, just like Sundar mentions, it's hard for the power, it's hard for the land, and for that reason, anybody who has it, you kind of have that opportunity. And I think we're going to see that at least for this year, maybe next year as well. Eventually that thesis could change, right? Eventually when maybe demand is not as crazy compared to the massive amount of data centers, it seems like data centers are going to be in every city with the amount of capex these companies are spending. But eventually I think you will have that talk. I personally don't think it's happening just yet. I think there's a lot of partnerships that are going to happen within those names.
Sam, you were really big into Iran, right? What are you expecting for tomorrow?
I don't know, because they moved up their earnings release to the same day as Amazon. There might be a deal, there might not be.
Isn't that usually a bullish signal, by the way, is if you move up your earnings?
I don't know. I don't want to speculate on that.
I'm pretty sure there is a little bit of research done on that, and it's actually like historically a good sign.
Pre-release. Okay, so when a company pre-releases earnings, it's because it's either really good or really bad. It's either really good because they have really good news that they need to say out publicly before it comes on the earnings, or it's really bad because they want to dampen the effect of the bad numbers that are going to come up. We've seen that happen a few times. Moving up the earnings date, I have no idea. I never really looked into that. I mean, I'm bullish. Well, I'm bullish Nebius and I'm bullish Iron. Those are my bets on it. I wouldn't be surprised if there's a deal with Anthropic. I would expect it. I didn't like the pump that someone did on Twitter about that. I thought that was a bit egregious that they would just do that, write that. And hey, if you're bullish, then it's trading at the same price it was before he made that rumor or whatever it was. How the stock's going to react after that, we'll see. We already have the bull case out there. They're going to have 2 billion ARR by the end of the year. So 3 billion, there you go. I keep on getting confused between Nebius and Iran in that one. Iran, they have not sold their capacity, right? So they do have 2+ gigawatts capacity still on sale. Nebius is completely sold out. They're both going to probably have further deals down the table. I mean, these companies can't do it on their own. Like, they're going to be hiring some of these neoclouds and miners and whatever to build it for them. But I don't think the market is this whole sector moves together, right? They move
together.
together.
Ask just one more question?
Yeah, go.
Okay, sorry. Just last one. Do you think that any of these names are acquisition targets for the bigger names, or maybe that M&A deal wouldn't even go through just because of, consolidation concerns, just because the big three have such a massive share of cloud revenue?
I don't think they want to acquire them. Otherwise, they would have by now. Because if they were to acquire them, then what are you acquiring exactly? The reason why they're signing the contracts to them is for legality terms, for being able to build it faster than they could. But like after this whole AI wave, my question is, what are half these companies going to do if they only build that and they don't have a cloud, right? Like why? Like Microsoft, Nebius has a cloud service, so does IREN. So they're technically competitors, but they're buying them for their services. Yeah, CoreWeave technically isn't like a full stack cloud service, but they do offer GPU and AI workloads as a service. But I'm bullish Cypher and all these other companies, but like, what purpose do they have after they build everything out? I don't know.
I would say it all depends, right, on the AI innovation and demand. I think right now they're doing these partnerships because it kind of creates a protection. It's like, okay, we're going to invest for the next 5 years, but if in the next 5 years we don't need it anymore, then we don't have to keep funding this. So it's like it helps make sure they don't completely overinvest. But if in 2 years from now, maybe they say, look, it's actually crazy, the demand, we need it even more. I would say it makes sense to acquire them, because then you're not longer paying that middleman margin, because you're definitely paying some form of middleman margin by kind of going with these partners. I think right now they're willing to pay that middleman margin just because they don't want to overinvest. But if the market continues to go this way, I think there's possibility for some acquisitions to happen, because they're going to try to improve those margins for Google Cloud or for Amazon AWS or for Microsoft Azure.
I mean, it's like the CoreWeave Core Scientific deal that didn't go through, right? CoreWeave wanted to buy Core Scientific because, again, they wanted to eliminate those costs in the middle. But for IREN tomorrow, for the market to still see it as a big, potentially very big neocloud player in the future, you would like to see the AI cloud revenue become a bigger chunk of the overall revenue. Because right now, still, the large majority of revenue comes from Bitcoin mining today. I think last quarter was 7 million in AI cloud, and the overall revenue was 240 or something like that. The market needs to see the AI cloud service business start to grow substantially, especially since they listed the amount of GPUs that they have, the even AMD GPUs that they have. So things need to change in that direction. I know everybody's focused on, we need a deal from Amazon or from Google or Anthropic. I don't know, every other day someone else tweets about another potential deal. But I want to see the AI cloud service business segment actually grow. Because so far it's been close to non-existent.
Yeah. We also got to remember the ARR that they got it for. That's annualizing the latest month of revenue they got for sales.
So it's 2027 basically.
Yeah. So like that's what it would be moving forward 2027. Like I personally don't think it matters what it is for this quarter for the sales for cloud revenue. The commentary is going to matter more. Like you don't want to hear Dan go on there, the co-CEO, and say like we're not hitting our targets or like we're running behind schedule, because they never do that. And I'm not bearish. Like I'm bullish. I'm just being realistic. I'm not coming into tomorrow and expecting IREN to pump up 20% after hours. Like, good Lord, they're gonna be.
I mean, it just sold off 20%. So
yeah, it just sold off 15% today. Like, I'm being realistic, guys. Like I'm not trying to play these earnings. I'm investing in these companies to see what's going to happen a year from now, not what's going to happen next week.
I think the most interesting thing about what's happening over the past couple of weeks is that these stocks that are all hurting a lot of portfolios are down when the S&P is barely down 1%. So if the S&P were to have a proper pullback, not even correction is 10%, S&P pullback is 5%. I mean, where do these stocks go? Like Rocket Lab was down 12% today on the S&P being down 50 basis points. And I think that's an interesting conversation. So then the follow-up question is, well, why is the S&P down, but Rocket Lab's down like 10x more than the S&P? Because JP Morgan, Walmart, Home Depot, those are the names that are pulling it up. And so I think the divergence here which happened literally this same time last year, is do you think Verizon outperforms NVIDIA by the end of the year? And that's how the market is almost framing the trajectory of what we're seeing in this stock price action. Now, last year, we had a moment like this. Verizon was outperforming NVIDIA. Verizon being the metaphor for value, NVIDIA being the metaphor for growth. Obviously, we saw what ended up happening. I don't know how this year plays out, but when you see earnings like that from Google, you start to wonder, why would institutional capital go to get a 7% dividend when they could expect at least 7% in capital appreciation from Google? I mean, it's up 5% year to date. And it's just interesting that everything high beta is wrecking people's portfolios, but the S&P is not. And so if the S&P, for whatever reason, Trump, geopolitics, labor market were to get corrected, I mean, high beta will be decimated. And I think that's the biggest fear right now, because this is happening basically without a reason outside of SaaS carnage, which might not even be real.
Yeah, I think companies can fall below their potential intrinsic value, something like this. But I don't know. I don't think that, like, if in a 2% S&P correction, ServiceNow falls 50%, that means that if we get down 5%, that this means sales or ServiceNow is down 90%. Like, I think actually they might be one of the more resilient names while the rest of the market corrects. Like,
yeah, but that doesn't matter. But that doesn't matter because ServiceNow is already down 50%. But Rocket Lab's not, right?
Well, yeah. I'm just saying companies that have corrected. I mean, they're not just all going to fall down 98% and just.
No, but my point at Bloom Energy, for example, is up.
Yeah, they have more to fall. Yeah, potentially.
But that a lot of people are levered, not just in Bloom Energy. They're levered into Bloom Energy. I mean, Bloom Energy is a metaphor for high beta.
Fucking don't do that. I didn't make them levered into those positions. Yeah. Be smarter.
You didn't do anything, but the point, you are part of the market. And if they get margin called on their Bloom Energy or their Ondas, you're gonna
they played the gamble game. Like,
yeah, but you're going to feel all of us going to feel the pain. All of us are going to feel the pain. That's my point from a broader macro perspective. If that happens.
Yeah, just the moral of the story is don't use margin and don't lever up to the T. I mean, that's just the moral of the story. Otherwise, you're going to get decimated. You've been decimated. If I look at SP sectors charts, like, it does not look like a blood today. In fact, the RSP, the equal weight SP 500, closed at all-time highs today, right? So if you're hurting, then you've been either levered or you're concentrating in a certain part of the market, which you shouldn't complain because you're probably up insanely in the last year. Right. So, like, zoom out, the Qs are still up insanely in the last year.
Yeah.
Right. And the market rotates. The market rotates like every few months. And this is just the case right now. In a couple of months, we could be singing a different tune. We could all be singing Kumbaya and shake our new cowbell, whatever cowbell we're going to get next week. But this is just what we're going to deal with right now. It is what it is. It is what it is. But the fundamentals is like we're fine.
Someone says by that argument, these stocks wouldn't be that high without people buying on margin. Exactly.
Yeah, that's true.
Like, if we get a deleveraging event, I mean, that's what happened in November, right?
It wasn't that long ago. I mean, a couple of months ago, right? When every tech company was at all-time highs. Markets were also at all-time highs, but the large majority of the S&P was nowhere near all-time highs.
Yeah.
A lot of the names were under the 200-day moving average. And now, couple of months later, we have actually a little rotation. So a lot of the names started to go up. And okay, the high flying ones are taking a breather right now. For a market health, this is very good. If you want to continue this bull market, okay, we're not talking about any external factors that might crash us, but I rather have a market where, okay, it's not just 7 companies that are driving this whole thing up, but it's also all of the other that are finally having their day in the sun, or actually last couple of weeks and months. Plus, it's not like we are trading. I mean, it's not 2021, 2022, where things were at 60 times PE, and that was the average and the norm. Yeah. You just said NVIDIA is what, 25 times forward earnings, and that's a $4-point-something trillion company. So it's completely different scenarios. But yes, you will have names that will definitely crash 50, 60, 70% or so. We've seen that happen in October, like in a month. Iron crashed 50%, CoreWeave down 50%, Nebius down 50%. But don't forget that these names were still up 300% on the year. So if you want to make 300%, yes, sometimes you're going to get hit by a nice little rug pull that happens instantly. It is what it is. If you want to make big bucks, you got to take a hit sometimes. It's like a nice little t-shirt.
Yeah, yeah.
All right, folks. That is it for us. Thank you all for being here. You can follow Sam, Neil, Jose, and Tanner. I'm putting the links in the chat for their Twitters and YouTube. And that was officially Google's earnings. Tanner, any last word from you?
No, bro. I loved it. It was great. Like I said, I cared more about the fundamentals than the actual stock performance. I knew they were not going to be correlated. Someone said in the chat, Tanner seems happy. He must have made money today. Quite the opposite, my friend. But I think, you know, the CapEx is a forward indicator for how I make money into the future. And like I said, by far my largest position is NVIDIA, and I'm just seeing the trends. People can call it expensive, what have you, but I mean, NVIDIA looks cheaper than the broader overall S&P 500 if you look at their PE versus NVIDIA. So do your own research, follow your own convictions. You can't borrow mine. Can't have it, okay? But I'm investing in tech still and going to take my lumps until I, you know, see my victory on the other side. It's a patience game.
I love it. Anyone else? Any last words?
Copy and paste.
Sweet.
Copy pasta is a good one. Maybe lasting. If you look at your portfolio, you probably own super good companies. Just because they're down a little bit over the past couple of days doesn't mean you're owning trash. Unless you still own PayPal after this horrible earnings report, then that's on you. I apologize.
Oh, can we hold on real quick while you're talking about PayPal?
Why do you?
No, I just wanted to say this. This is just like my PSA to everybody. Can we stop dunking on people that pick a stock and it goes down, acting as if everyone knows every stock that's going to go up? Like the amount of hate people are getting because they picked a stock, they defended the stock ended up not working out, and so they decide to leave. And we want to dunk on them like they're the worst human beings. Like Berkshire Hathaway, like Buffett didn't mess up with Kraft Heinz for 20 years. Like it is kind of just weird to me in the overall. And I'm not saying everyone here does this, but like when you see these toxic people on Twitter saying, oh, wow, you were in PayPal. It's like, yeah, I'm going to get stocks wrong throughout my life if we're doing this for the next 30, 40 years. So is Tanner, so is Sam, so is Jose, so is Neil. We have all probably gotten a couple stocks wrong over the past couple of years. Having the courage to even try to defend a name and then stick with it and then ultimately adjust, even if you are wrong, is part of the game. That's it. It's part of the game. You don't survive in this industry for the next 30, 40 years if we want to do this for the next 3, 4, 5 decades without getting shit wrong. So I think a lot of the people that are just trying to spread misery because someone got a name wrong, like grab his earnings in a week. I don't know if that stock's going to go up. Maybe it goes down. SoFi, great earnings. Tanner's been pitching that name for a long time. Phenomenal earnings. That stock is down. Hood, phenomenal execution. That stock is down. No, I'm just saying it's just like
pick a different name.
it's not just Neil who likes PayPal and therefore PayPal's down, or Jose who likes CoreWeave and CoreWeave's down, or me who likes Hood and Hood is down, or Tanner who likes SoFi and SoFi is down. Like it's part of the game. And when the market corrects, some names will get corrected worse than others, but we cannot pick on people and make them feel like horrible human beings because they didn't have the best stock pick, especially if those stocks are in a correction, not those stocks are, going bankrupt.
Yeah, I mean,
or if management lied, then
some people had PayPal here. I had Skills. Amit had Grab. No, I'm just kidding. Grab is in the future. I'm just
but Grab could have a bad or good earnings. I don't know. We're gonna see. SoFi had a great earnings. That stock is still down. Should anyone be blaming Tanner for that? Absolutely not. So it's just like, I don't know. There's too much toxicity when things go red and people act like they are the sage that knows every single thing that's going to go up or down. When in reality, they don't have a public profile. They don't even have a profile picture on Twitter, but they want to talk so much shit. It's like Buffett got things wrong. Ackman got things wrong. It happens.
I like how, everyone's ragging on Tom Lee. Like, I get it, the whole thing, but like the dude's been right for like 3 years and then he gets like one thing wrong. I guess the problem was that, people blasted it, but it happens, right? It happens. At the end of the day, the guy's been bullish for 3 years and then he gets one thing wrong and it's like, he's the worst guy on the planet, but it's like, dude, he's He's been around for decades. So same thing with Kramer too. Kramer's been around for decades. I don't like it's a joke, inverse Kramer, whatever, but like the guy's a freaking legend. I'm sorry, Kramer's a legend. So
yeah, and again, the funny thing about this is like
Went
for
a
those
little
that
far with that, but yeah, okay.
For those that know Neil or watch his videos, this guy analyzes stocks. Like he knows how to analyze a company. So his analysis that I've kept up with over the past couple of years on PayPal was very good analysis. It's just at the end of the day, when management is not going according to plan and the industry is kind of having a different view of fintech, sometimes things don't work out. But he's not saying, yes, PayPal is amazing because he likes Alex Chris. It's like, no, the stock's undervalued. They're buying back 50% of the company in like 7 years. Like there's real numbers and analysis associated with this stuff. I think Tanner does a phenomenal job analyzing SoFi. Those numbers were very concrete, but the stock still gets corrected. Like this shit happens is my point. It happens. Palantir put up, I think, one of the best quarters in history 2 days ago, and that stock down 12% on the day. Now, Palantir is an expensive multiple. I get it. But the point is, it's like, it's not going to be perfect all the time, especially when SoFi went from 4 to 25. Palantir went from 6 to 150. Hood went from 7 to 150. Like all these names have also had a massive, massive run. CoreWeave IPO'd at 30. It's at 85 right now. If you bought it at 120, yeah, that's bad, but it's not like, I don't know. I just think we got to be nicer to each other. That's all.
Also,
right.
what's the point in dunking on people when they lose money? Like, focus on you making money and let the other guys do whatever they want. It's not just the PayPal, although the PayPal, the thesis was correct based on the information that I got.
Oh, I got to go as well. Sorry.
It just sucked in the end.
Later.
Micron.
Yeah, and if you're gonna give freaking Neil shit for PayPal, you got to remember this guy called Micron at $60, right? So it's like, I don't know. I just think the toxicity of a market going down and certain names not being the best can't be the dominating discourse. And if it is, it's like, what's the point of even being part of a community? People are gonna get shit wrong. It happens.
Indeed it does, but as long as we have more winners than losers, couldn't care less. I'll probably be wrong in the future again, but again, if you are right more times than you are wrong, you are probably going to be a legendary investor. It just happens that, yes, negativity sells, so if people want to shit on me in the comments or send me messages, go ahead, doesn't matter.
Yeah, I mean, Ackman sold to Netflix. I forgot about that. That was pretty bad. That was not the best thing. Yeah, and I agree. Look, and in terms of Tom Lee, like, you know, there are when you analyze these situations, they also have to be pretty nuanced. I think the way the communication has gone about this whole BMNR Ethereum thing is pretty egregious. And so I'm not saying you shouldn't critique people. I'm not saying, you know, you can't make analysis around Neil's analysis of PayPal or my analysis of Grab or how Tom is talking about BMNR. I'm just saying going out of your way to hate people because a stock might not be going in the direction that you want it to go in, it's not the most productive thing. But, you know, this is what makes a market. And as Neil says, as long as you're more right than wrong over the long term, that's what matters. All right. That's it for us. Jose, any last words on Google or anything else?
Nope. Just be nice, people.
Are we back tomorrow for Amazon or what?
Yeah, we all three will be doing Amazon tomorrow.
Perfecto.
And probably Tanner as well. So it'll be all four of us again. All right. Thank you, everybody. We'll see you guys tomorrow on the market open and for Amazon. Bye, everybody. Have a good one.